Welcome, everybody, to another episode of the Quantum Action Podcast. We're here to take you to infinity and beyond. And with me today, I have Gordon Bizar, who's talking to me from California. Gordon's a business expert. He helps and he's been buying businesses for years and turning them around. So we're going to talk about business in 2023, about what businesses to invest in and how to turn businesses around and make a profit. Gordon, welcome to the show.
Well, thanks, Fab. It's a fabulous pleasure to be here.
Great, thank you. So, Gordon, tell us about, what's happening. What do you think is going to happen in 2023, and what business opportunities, what sectors do you think are going to be the ones to invest in, from small businesses to large businesses?
Sure. Well, I see 2023 as an example of the good, the bad, and the ugly.
Okay, yeah.
Let's get the ugly out of the way first. There's a pretty good indication that this is going to be a recession, and it'll be worldwide, and there'll be a lot of businesses that'll suffer through all of that, and that's the ugly, and then I can leave that for the rest of the interview. The bad is that it's not going to be a good time for most businesses, but there's going to be a handful of industries that are going to prosper through this period. And I'm glad to have the opportunity to talk through them with you so that if people are thinking of fields to go in or places to make investments, that they're able to differentiate those industries that will do well during this period of time and actually will continue to do well for some time into the future. So if you want to know which ones they are, I'll be happy to respond to that.
Yeah, let's be positive and let's talk about those industries that are going to thrive in this recession. I believe we're already in the recession. It certainly looks like it over here in England. And I was talking to somebody the other day, and you see that stuff that was priced at $9.99 hasn't gone up by 4 or 5%, as they say. Inflation's gone up. It's gone from $9.99 to $14.99 because that's what they'll up the price. That's what they've been doing. They've been upping it to $14.99. So now there's like a 25% increase. So that's the reality of inflation right now, 25 to 30%, and sometimes even more. And this obviously is hitting a lot of people and a lot of businesses. So which businesses do you think then are going to be thriving in this economy?
Well, we've given a lot of thought to that over the last year or two. And we've focused now on two industries because they are basically recession proof and inflation proof. Mm-hmm. Okay, and the two industries are one you know of. It's jet charter and the whole private jet transportation industry. Mm-hmm. And then the other one is healthcare. Both of those are recession proof and inflation proof, and I'll share with you the reasons behind that in each industry. Because sometimes people say, well, everybody says stuff, but nobody can prove it, right? So we're going to give you the logic behind all this. Okay, we're focused on the ultra high net worth individual sector of the jet charter marketplace, okay? And the reason for that is when people, and by the way, the definition of an ultra high net worth individual is somebody who has $30 million of liquid capital available to invest at any time. All right, so if you're in that category, you're in a very elite group. It's not the tippy top of the ultra high net worth individuals, but it's the folks who have a lot of money. It's not the multi-billionaires. It's the folks who have hundreds of millions and a billion or two. Okay, so anyway, there's about 530,000 of them worldwide. 40% of them are in the United States. And they never change their lifestyles no matter what's going on in the economy. They may change the decisions that they make in business and the things that they'll do in business, but they don't change their lifestyle. They still spend the same amount of money on everything that they spend their money on. It doesn't matter what it is. They're going to live the way they're going to live, and they don't care about what's going on in the economic environment. And so that's one of our target markets. And then the second target market that we have is in the healthcare field, where we identify those healthcare sectors that are growing rapidly because of changes that are going on in healthcare. But the whole healthcare industry is growing, but some of them are growing phenomenally well. One of the areas that we're focused on right now that we're acquiring is urgent care centers.
Hmm.
Urgent care centers have come on very strong, for example, because the hospitals can't really service the certain markets efficiently. Their cost basis for their services are just too high. So you're starting to see these corner operations pop up where you can go in, get immediate treatment by a physician, and not have to go to the emergency room, not have to go to the hospital, no long lines. Most healthcare, in fact, all healthcare insurance will cover the expenses because they would rather pay for the lower expense of these centers than for the ones that go to the hospital emergency room where it's going to be a lot more expensive. And then people who don't have insurance at all, they don't really have a choice. They have to go to a place like that because the doctor is going to charge them way too much. So those are the two industries that we like. We're also in the healthcare into home care, nursing.
Yeah.
So there are services that we acquire that are active in providing a person who normally would have required hospital attention, but now they're able to get that service at home under a
Hmm.
much more favorable cost experience than they could at a hospital. So anything in the healthcare industry that gets a person out of a hospital or out of an emergency room and into a lower cost methodology is going to be a growth industry for some time to come. So it takes advantage of the fact that the prices are increasing to give people an alternative to where they can spend their money and get more for less. And yet people who need healthcare, they got to go. I mean, if you just broke your arm, you got to do something about it, right? So you don't really have a choice, and the inflation and the recession don't really affect that. So those are the two industries that we're very heavy right now in making acquisitions, and that's essentially the reasons why.
Okay. So, how do you buy business? Now, I know you've bought lots of businesses over the years and turned them around. So, what does one have to look for when they're looking to buy a business?
Okay, well, first of all, I don't look for businesses to turn around. I
Okay.
look for businesses that are extraordinarily profitable already.
Hmm.
And I look for businesses where, because of my past experience and because of my knowledge base, I can make a positive difference in
Hmm.
that business's ability to earn money.
Okay. So,
So
so instead of buying something that's not doing too well and make it go well, you're taking something that's already doing good and you make it great. Is that right?
that that's the much better thing, and it all comes down to value added. If I
Okay.
can't add value to, in fact, if I can't add substantial value to a business, then it doesn't need me.
Yeah.
Okay, the whole idea for doing an acquisition is to take something, as you said, that's doing well, but now add technology to it, add a better business model,
Hmm.
revamp the way that they handle their back office and make it way more efficient. Uh, Give them alternative ways that they can get much more sales,
Hmm.
and take their existing client base and create more revenue streams from their existing client base. So I already have a plan for that company when I acquire it of how I'm going to double, if not triple, its sales at least over the next period of time. And then I'm going to want to take companies that I can buy at a private ownership multiple of EBITDA, which is going to be relatively low compared to the public
Hmm.
multiple of EBITDA. So
Yeah.
I buy companies that I can consolidate, add my value, bring up their income, and then take them public at a much higher multiple of value than the price that I had to pay for them when they were private companies. And so I look at acquisition as a tool that I can use to build businesses, to take businesses that are perhaps stuck in the existing business models of the 20th century and
Hmm.
bring them into the 21st century business models and make them a lot more profitable, take them public, and create generational wealth in that process.
So you've decided to go in this direction because there are people out there that buy businesses that aren't doing very well and turn them around. Why have you decided to stay
That's
away
work.
from
That's
that route?
work. Okay. When you do that, it's work. Okay. Because you got to get in there and you got to
Yeah,
deal with maybe
yeah,
unions and you got to
yeah,
deal with all these reasons why they're not doing well. Well, if that's your skill or your expertise, great. And the world
yeah,
needs that.
yeah.
It just happens that it's not mine. Mine is building. Mine is taking things that already are doing well and then bringing them to a level that the people who own them never dreamed that they could go to that level. And by the way, doing it in a way where I make the owners my partners.
Yeah.
Okay. In other words, I don't buy them with the idea that they're going to leave, because if they're doing well, the chances are it's the management and ownership that are the reason it's doing well.
Yeah.
So my task is to convince the owner that if they'll work with me, I can literally partner with them, make them a lot more money than they're making now, and do it in a way where we both win through the IPO. And so it's a different philosophy about buying businesses. A lot of times people buy businesses with the idea they're going to control them and they're going to build their empire of control. We don't do that, okay? We take really talented people and support the hell out of them. In other words, if they built the business to that level, we're going to give them the tools to build it even better. And so we're going to make sure they're well capitalized. We're going to make sure that they've got a better business model. We're going to make sure they got better technology. We're going to make sure that they got access to everything they need to grow, and then support the hell out of them.
Yeah, that makes perfect sense. I mean, sometimes people, they have their own business and maybe they don't know how to modernize. Maybe they don't know about certain things that you can do to improve the business, and that's where you come along with your value to sort of add to that. So you don't always buy. So you don't always buy the whole business. Then you buy a good percentage of it. So you have control.
No. Here's what we do.
Yeah.
Okay, we buy the whole business.
Okay.
And we pay them cash for it. In other words, so that they put a lot of cash in their pocket.
Mm-hmm.
Okay. Then on the other side, what we do is we created a vehicle, if you will, based on their performance with our help. They're going to build the company. Well, if they build it at a certain rate, they're going to qualify for equity in our company that bought their company. And the amount of equity they get in our company will be worth more than the price that they sold us the business for in the first place. So we give them a double win. They win in cash when we acquire the company, and then they win in equity in the IPO when we go there. And they get an opportunity with us to do that, with our full support in making it happen. We're totally into win-win business models. When we do these things, Fab, the idea is there are no losers, okay? Everybody wins. And if we can't do it that way, we just don't even do it, because that's the fun of what I do, is working with people where we all win together.
No, it makes perfect sense. I mean, at the end of the day, because sometimes, especially with businesses like you were talking about, private jet business, I mean, that's very much a relationship business. So, you may have a guy that has 10 airplanes under management. That person in charge will have a relationship with every single one of those airplane owners. If suddenly you take that person out of the equation, that relationship's gone. The chances that those 10 planes stay with you are probably, I'm not going to say next to nothing, but, especially at that level, relationships are really, really important. I mean, a lot of private jets, a lot of luxury homes, yachts get sold quietly off market. More than on market, because just those people are networked into each other, and so they just pick the phone up when they want to sell their airplane or their villa or whatever. They make a few calls and the deal's done. The ones that you end up seeing on the internet, are not the best of the deals. So it's very much, and so the fact that you keep those people on, you pay them cash for their business, and then they've got more money they can make as they help you grow the business and take it to the next level. As you said, it's a win-win situation, which is great. Now, tell us, Gordon, about how you got to where you are today. I mean, how did you get involved in doing this type of business? How did you kind of start out in that? Tell us your kind of backstory, because I'm sure those that are listening will be very interested.
Well, first of all, I came from a business family. My great-grandparents were small business owners. My parents were small business owners. So I grew up in a business environment. Around the dinner table, there was business conversation. So I was comfortable with the idea of being in a business yourself. And then when I was about, I would say 17 or 18 years old, I read an article in the Wall Street Journal. And yes, I read the Wall Street Journal when I was 17 or 18 years old. And there was an article in there about how somebody had accomplished what's called a leveraged buyout. In other words, without cash of their own, they totally leveraged the purchase of a business. And in the article, it had a brief outline of how it was done. And so I just read it and I said, I could do that. So when I was in my early 20s, I decided I was going to apply that method. I wanted to try it. So I found a small manufacturing company that manufactured motorcycle front end fork tubes for the excuse me, motorcycle aftermarket. And it was an interesting business to me. And so I thought, I mean, I rode motorcycles as a young man. And so it was an interesting field for me. Without getting into the whole story of how I found the company and all of that, I ended up buying the company, and I did it without any capital of my own. And the way I did it is, in the business that I wanted to buy are assets, right? Machinery and equipment, inventory, accounts receivable. There's all of these assets, and those assets are financeable. So I'm going to use numbers that were applicable in the 60s,
Okay.
or at 69, this is 70.
Yeah.
So,
Okay.
so these numbers would be multiplied by 15 right now. If I were to find the same business, the numbers would be a lot higher.
Yeah.
But anyway, the owner had an asking price on the company of $500,000.
Mm-hmm.
And what I found when I investigated the business is that it had a couple of $100,000 worth of assets, machinery, equipment, accounts receivable, inventory, et cetera. So I found an asset-based lender that, once I owned the company, would loan me $190,000 on those assets.
Mm-hmm.
The seller finally agreed to sell me the company for $150,000 cash down. So I had to come up with $150,000 cash, but then he would take back a note for the difference, and I could pay him out of the profits of the business going forward. So here I am. I can see where all the money is, but I just don't have it in my hand.
Mm-hmm.
So I went to at that time, the Bank of America, and I sat across the table from a loan officer, and I explained this plan of how I wanted to buy this business, but I needed $150,000 down. But then once I gave the seller the down payment, that I could borrow against these assets, and I could pay him back what that time would be called a bridge loan. Okay. In other words, he was going to loan me the money to get the business. Then from the business assets, I would get a loan and pay him back.
Mm-hmm.
Okay. Well, the banker looked across the table at me, across the top of his horn-rimmed glasses, and he says to me, "Now, son, you don't think we're going to loan you $150,000?" Well, anyway, long story short, I explained to him how the bank would never take any risk. Okay. That what we could do is, at his bank, in his trust department, we could set up an escrow account, what's called a double escrow. In one escrow, he would put in other words, all the documentation, everything that would make the business mine, the purchase agreement, everything. In the other escrow, I would go to these asset-based lenders and have them put their loan to me in an escrow that would close once I owned the business. So once I owned the business, then everything that was in that second escrow was my signature on a business that I owned, right? So the two escrows closed at the same time. The banker controlled everything from from his own trust department. The money never left his bank in reality. Okay, so he was a happy guy. He saw where there was no risk to him, because the one escrow couldn't close until the other one did. So he couldn't have his money going out to me until the other money was coming back to him from the second escrow. So with that, I was able to buy that first business, and I did it without any capital of my own. And I said, this is a pretty interesting thing. And then the second part of the process was, I started to buy out my competitors using a similar technique to that. And eventually I dominated the front end fork tube part of the motorcycle aftermarket. And so with that, I was able to raise prices, increase my margins, became a very, very profitable business. And then I started buying other companies that made other metal fabricated parts for motorcycles. So handlebars, tweak bars, fenders, anything you made out of metal. Okay. And then eventually a company that it was Bard Chemical, which was a New York Stock Exchange company. At that time, they were kind of a conglomerate. They owned lots of stuff, and they owned a plastics manufacturing company. And the plastic company did plastic parts for motorcycles, like gas tanks, fairings, they just helmets, all kinds of things. So here I was making all the metal fabricated parts, but because I owned almost the entire production in the United States of front end fork tubes, every distributor in the United States bought from me. And so I was able to leverage that relationship to get all my products into those distributorships, because if they wouldn't take my other products, I wouldn't sell them front end fork tubes. They had to have front end fork tubes, so they took my entire line. So when Bard understood that, they realized that for their fairing company and their helmet company, if they bought me, that they could leverage their products into all the dealerships in the United States. So at the end of the day, they not only paid me what my company was worth in terms of its profitability, they paid me a premium for it because they could now use my product line to leverage their products into many, many more dealerships. And so that's how I got out of the business with a very substantial profit. And that's how I really fully understood what a strategic buyer can pay for a company, because they win twice. They win when they get your profits, and then they win because they leverage your product line into other profits for the company that they already own. And so at that point, I'd run the full circle of acquiring the business, leveraging no capital into all the capital I needed to do it, and then selling it to a larger company for a big cash out profit. And then from then, my life got a whole lot easier.
Yeah. So the escrow was really the key to making that deal happen.
Yeah. The idea of understanding that in acquisition, it's not just capital, it's timing.
Yeah.
Okay. Yeah. If you don't have the money now, there's a way to leverage other types of instruments to change the time dimension. So the time is not the problem, because the time differential was very clear. I had to have the money to buy the company. So I had to create a vehicle that made time go away.
Yeah, yeah, that's very clever. And I guess over time you've perfected the model as you've moved along. Now, have you just done businesses in the US, or have you done stuff internationally as well?
Yeah, well, that was my next point, is what I did once I learned how to do that. The next step was, how can I make money with that intellectual property? In other words, when you have knowledge of how to do something like that, that's intellectual property, and that property has value if you can monetize it. Yeah. So one of the ways that I monetized it was I started a training program for entrepreneurs on how to do leverage buyouts. Yeah. Okay, and as of today, I've had over 350,000 people come through my course worldwide, and so that built a tremendous network for me. So I not only monetized it by training other people how to do it, but then I created a network of people that would bring deals to me. Okay. In fact, the way I first met you is through Arthur. Arthur and I have known each other for years. He came to me through my network. Through him, I met you. So that's the way that works. And so a lot of deals came to me because the people that I trained were now over their head. They didn't have the capacity to do 100, 200, $500 million deals. Yeah. So that became a source of that. And so that was very, very prolific for me also. But the point that I wanted to make here is in teaching that course, it did as much to educate me as it did my students. Because what would happen is we would train some pretty talented people on how to do what I knew how to do. Yeah. And they would come back to me and they would say, you know, Bizar, that thing you taught me how to do, that was great, but it didn't quite work for me. So here's what I did. Well, wow, they had developed a new adjunct to that technique that made it work a little better, or even just a little bit different, and now opened up a whole new method of doing it. Well, you multiply that by 40 years of doing that program. Yeah, well, our program today covers hundreds of techniques, not just the one I gave you. And so the one I'm exercising today is a whole new level above that first leverage buyout. I mean, it's incredibly different. And today also, by the nature of these businesses, I'm able to offer investors such a high return on their money and to minimize their risk, that when I go to do a deal, the investors are there waiting for me.
Yeah.
they want to do it. Why? Because here's my track record. Here's how the deal is laid out. Here's how I minimize your risk. In fact, make it go away altogether. And here's how I'm able to give you this phenomenal return. And I get enough people saying yes, that financing a deal is now very, very easy to do.
Okay, very very interesting. So how does now there's a few people out there online that are trying to do what you do. One of them in particular is very loud and teaches in a castle, and charges a bit of money and insults people all the way along for a week, um, which I know you don't do. You have a very gentleman approach to it. How would you say your system is different to others out there, besides what you've already told me? What else is there that's unique that you can disclose, of course?
Well, yeah, yeah. I mean, it's like, remember what I said, the most important element is time. First of all, if you have to yell at people, you're in the wrong business.
Yeah.
Okay. It reminds me, when I was a kid, my mom wanted me to learn how to play the accordion. I wasn't really crazy about the accordion, but all right, it was music and I was kind of liking it. Well,
Yeah.
she sent me to a teacher who, when I missed a note or I didn't play something right, he would grab me by the hair and he would shake my head as well, I dropped the accordion real fast, right?
Yeah.
So, what that taught me in life is you don't teach people with authoritarianism. You don't teach them by giving them pain when they make a mistake. You teach them by getting at a level of logic with them where they can truly see for themselves what the benefits are and how the benefits work for them. And they get in touch with how they win when they do it right, when they follow a certain formula or better. And that became just the basis of my philosophy when I work with people. When I work with these acquiring businesses, I'm an enroller. I'm not an acquirer.
Hmm.
I enroll people in my project. I get them to see how they win. I get them to want to be a part of it. And in fact, one of my methods of training people is, look, it's not the numbers, it's cosmic bond. When you build a cosmic bond with the owner, when you're traveling on the same plane, when you see a commonality of your background, when you enjoy talking with each other and strategizing on how the business can be better, you build that link with them of trust, respect, and like. Okay, people do business with people they like, trust, and respect. Okay, and if you build that relationship with the seller, that's the whole idea of it. And now when they're going to stay on in the business and you're going to work together to build it together, that becomes the bond that makes all of that possible. So the acquisition business is really the relationship business. And so that's what makes me very different than anybody else out there, because
No,
I'm
no,
big.
I agree, because I know a lot of people that do what you do, but they have some of these people have a very shark approach. So there's one gentleman I was talking to the other week, and he hunts around the world for people that want to sell their business because they're either retiring, their children don't want to inherit, or they've got themselves in a bit of a 2 and 8 and they don't know what to do with the business. And so you can just go in and buy it for almost next to nothing, get rid of the previous owner, and then do your own thing. But that's
Okay, but
almost like taking advantage of people, and I don't like that. Well,
yeah,
your approach is it's a non-shark approach, as
right.
you said. It's a win-win across the board, and it's taking a good company and making it great. And I think that's a great solution for everybody, really.
Right. Well, again, I look at every company in terms of, from my standpoint, as value added. Okay. So I totally respect what the business owner went through to build it.
Yeah.
Okay. I want to offer him a better future than he can build on his own.
Hmm.
And I want to be able to go to that party with a methodology by which I can support their growth and they give up nothing. In other
Yeah.
words, when a person goes into business as an entrepreneur, a lot of times it's not even the money that they went into business for. It's the control. It's the idea that they want to be in control. They're betting on themselves and their own ability to do it, and they really don't want anybody telling them what to do. Okay, so that's a big part of being that successful entrepreneur.
Yeah.
Well, I don't want to take that away from them. That's an asset to me. I don't
Yeah.
want to micromanage their business. I want them to run the business. The reason I'm buying this company is because it's well run. Okay, so I'm not going to second guess that person. So in the relationship or the contractual arrangements by which the company is bought, they remain in control of that business. And what I become for them is their acquisition arm. Okay. In other words, they know how to build a business by internal growth, by increasing sales and operational efficiency and effectiveness. What they're not an expert in is acquisition. Well, if they're a great company, then we make them a platform company. In other words, we make that the platform and they're going to run it. Now, we're going to roll up businesses underneath them and let them manage those businesses too. So we're going to give them more to control, more power, more of everything they went into business for in the first place, and none of the problems. I don't want to run their business. I don't want to micromanage it. To me, that's leverage. If I got to go run their business, that's not leverage because now I got work to do. Okay, it's leverage when I bring that business into our portfolio of businesses, if you will. They run the business, and now I'm leveraging that because I don't have to do all that stuff.
I should imagine, Gordon, that I mean the due diligence on finding the right deals. I mean this is probably the most difficult part is finding a company that ticks all those boxes. Because you've got to you've got to be in the right market. They've got to have the right type of people in there. They've got to be doing a good job already. There's got to be margin for it to grow. You've got to be able to add value. I should imagine there aren't that many businesses out there that tick all those boxes, and so you have to really do your due diligence when you come
Yeah,
across something to make
yeah,
sure that it ticks all those boxes.
yeah. And your method of finding them needs to
Yes.
be finely tuned.
Okay.
Okay, so for example, um, when I go into a new industry for me, the first thing I have to find is my champion.
Yeah.
I
Yeah.
have to find somebody in that industry who shares a vision with me. And that is we can build this industry bigger, better, faster than it's being built now.
Hmm.
And I look for people who, number one, after I meet them, I find out if they really share my values or not. Okay,
Hmm.
because I'm a win-win guy. If they're not win-win, I'm not doing it with them.
Hmm.
Okay, so we've got to share values. We've got to be people who want to add value to everything. And the second thing is they either know the industry really, really well. They know who the right people are. Let's take the jet charter business.
Yeah.
You know a lot of the people out there. In fact, I would say with what your background is, you probably know most of them.
Yeah.
You know who the good guys are. You know who the guys are that aren't that are the sharks. Okay,
Yeah.
that are looking for how do they steal more money
Yeah.
without producing anything, right?
Hmm.
So somebody like yourself as an insider in my company starts to direct me in the right direction. Then the due diligence does take over.
Hmm.
But everybody's got a reputation out there that have been in business. And so if you look at a business not as numbers, but
Hmm.
as relationships and a business of people, then
Hmm.
your approach to the business is very different because the first thing you're doing is validating that the people who run that business are the right folks for you. Then when you get them online, you can see, it's like it's almost like metaphysical.
Hmm.
People who have the same values, the same that are alike, draw each other. There's a magnetism that happens when they
Yeah.
meet each other.
That's
Okay,
true.
so I look for that magnetism. Okay, so that when I'm talking to them, I'm not talking to somebody that my thoughts are alien to them. I'm
Hmm.
talking to somebody who will get where we're going together very, very quickly. So once the bond is right, once the people are right, that's when the process starts. So now I've got my platform company for that particular, I call them verticals for that
Yeah.
particular industry. All
Hmm.
right. And then once I do that, now on the roll up side, I don't care as much about the relationships. In fact, there I'm tending to buy businesses where people have run them for a while. They're doing reasonably well. Maybe they're even struggling a little bit, but it's
Hmm.
time to retire. Okay, the difference is I'll pay them a fair price for the business because I know I'm going to add a lot to that. So I'm
Yeah.
still not going to turn into the shark.
Yeah.
I'm still going to work with them and make sure that they're taken care of because their relationships are still important. And I want them to stay on for a year or two so that they can transfer those relationships to the people that are in the platform company that's
Hmm.
now going to run that business. So
Yeah.
we want to treat everybody fairly. We want to leverage the relationships. We want the relationships to carry forward. And so now we've got a business that we can transfer the full value of that business to the platform company. And so that's part of how we're going to help the seller win from the roll-up business, and it's part of how we're going to make the seller who sold us the platform company win, because as their company is built, even though it's more than just their sales, even though I'm adding sales to the business, they're still going to win from the sales I add through helping them acquire more companies and the amount of equity that they get in the company that's going public. So as you can see, it's a whole different business model. It's not the idea of being, getting the last dollar on the table, negotiating to squeeze the other party down so you can make more money. Because at the end of the day, I guarantee you, I'll make more money because of the relationships that I've built in the company than anybody who takes the shark approach. And
it's also less risk for you. I mean, if you're buying something with a team in place that already knows what they're doing, I mean, there's no surprises. And if you've got your trusted advisor there, like for aviation myself, I have been steering you. Yes, that one. No to that one. Yes to that one. It's important to have that. Now, in closing, to a young person that's been watching this or listening to this and thinks, this is interesting, I'd like to start to do what Gordon does. Where do they start?
Well, I hate to self-promote here, but over time, I developed this program called Bizar Financing, and it teaches you, starts with how do you do a leverage buyout, because it's that logic that you've got to understand, because in it you start to learn how to exchange time and how to exchange money and make them both work for you, and how to leverage both time and money. It'll also teach you how to leverage relationships. Okay. And it's an elementary, starts at the elementary level with a program called Bizar Financing Essentials. And it's what you have to know to do all this stuff. And then for those people who are really serious about it, they go on to Bizar Financing Pro, which now we teach them every concept of how this is done. And remember, this is not old stuff. Okay, this is the evolution of everything we've learned over the last 40 years, because guess what? Time cycles. There's inflation, there's all of the economic things that you're seeing now. Guess what? They happened 40 years ago.
So Gordon,
we had to overcome them.
Are these courses in person or are they online? How does that?
Everything's delivered online, but a lot of it is through webinars. So there's video, there's printed materials, there's tools. Like a calculator that helps you quickly understand the value of the company and get right to what's it worth. How do you buy this company? And here are all the leverage tools that you can use to leverage money. And here's where they can all come from. And now you can apply them to how you're going to buy this business, and then measure your cash flow afterwards, because maybe you can borrow all the money, but the profits aren't there to pay the debt service. So you got to know where every dollar is coming from, and then you got to measure the cash flow to know that it's actually going to get paid for from the company. So all those tools are there, and we produced a half-hour, or 26-minute video that people can see online. It's free. It's called Getting Rich Your Way, gettingrichyourway.com. Yeah. Okay. And you just go there and you click on it and watch the video, and it'll show you how other people have done all this stuff. And if you like what you hear, you enroll in Bizar Financing Essentials, and that's your step into the whole process.
So do you do any live in-person courses these days, or is it just all digital?
I don't have the time. I really don't have the time. But I do have the ability to do meetings like this. Right. So, in fact, I would say that people kid me, because you see this triptych behind me. Well, it's expansive, and if you were looking at the whole thing, it looks like I have the whole universe behind my head. And I refer to my office as intergalactic headquarters for my enterprises. Okay. And the reason is I don't have to leave this chair to do deals anymore. I can get everything done right from here. And yes, when it comes time to meet a seller face to face, I'll take the plane trip, all right, or whatever. But time is so efficient for me using the internet. It's like hard to do it any other way. And so today I'm able to do everything pretty much video wise, or webinar wise, or Zoom wise, whatever it is. And so, even the negotiations that we end up doing today, a lot of companies we buy, they have an investment banking firm representing them, okay, whose job it is to get them the maximum price. So I end up, most of my time I spend talking to investment bankers who are negotiating on behalf of a seller. Now, I do meet the seller through these vehicles, and we do get a chance to bond a little bit and to get to know each other. But it's really come down to where we're negotiating with them, and I'm able to do that right through these types of mediums. And fortunately, I'm knowledgeable enough in the fields that I'm in that I know if they're pulling my string. In fact, we had one today where they were saying that their company was worth a higher multiple than we offered. And what I was able to share with them is no, and here's the reasons why. And I was able to go through them when they gave me examples of higher multiples of deals. I say, yeah, but they were back in 21 and the early part of 20, before the inflation went rampant, before the interest rates started to drive. And higher the interest rates, the lower the value of a business, because your cost of the money, your money cost to make the acquisition go up, which makes the acquisition worth less. It's kind of like real estate. When the interest rates go up, what happens to the price of homes? They come down. Why? Because people can only afford so much to pay for them, and if it's going to interest, they can't go to purchase price. Okay, so I was able, I'm able to demonstrate all that and put it down into mathematical terms that it gets very hard to argue with.
Yeah. Gordon, thank you very much for being on the show. Thank you for your time. And those of you that are watching, if you haven't subscribed yet, remember to subscribe to the Quantum Action Podcast. We're here to take you to infinity and beyond, and we'll see you on the next one.